Welcome, everyone, to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money color commentator. On today's show, qualified retirement accounts could lose up to 40%. Part 3 in our series on your retirement reality check with author, speaker, and investment advisor representative, Lindahl Lucas. Welcome to the segment, Lindahl.
Steve, thank you for having me.
I just want to remind everyone, Lindahl has a book out, named the title of our show, The Retirement Reality Check. It's out on Amazon.com. It'll be out here in about, I don't know how many weeks or so it's coming out.
It'll be out here in about 2-3 weeks.
2-3 weeks. And he's got another book on called The Pros and Cons of Annuities. It's a good, easy read. If you've said, I have a debate, should I use annuities in my retirement or not? I think you'll find it to be fair, arbitrary, not arbitrary, but an arbiter of truth.
Yes.
Right? And I want to talk about this issue because my client came up to me one the other day and said, hey, I have $1 million in my portfolio. I said, well, maybe not. It's not all yours.
Yes.
40% belongs to Uncle Sam in some way or another. And he goes, oh, it can't be that big. Well, it might.
Yeah.
$1 million, depending upon your required minimum distribution. Let's talk about the first subject matter in taxes, which burns everybody's goat when I bring it up. Lindahl.
Yes, sir.
We're paying taxes on Social Security benefits. By the way, they told us in the 50s that they never would do this, and now they're charging us taxes on our benefits.
If you hit a certain adjusted gross income, and if it's single, it's a little less. If you're married, a little bit more. But once you hit that level of income, then everything's taxed.
Okay, so I just looked at this, and I just want to explain this to our viewers. There are only 4 things that don't cause your Social Security to get taxed, and we're going to talk about that in the succeeding segment.
Yeah.
But that means that everything else does.
Yes.
All right, I just want a heads up here. So when we go through a few of these items today, you're going to go, how can that be? But it is. And remember, all my friends that are baby boomers right now that are taking constructive received Social Security are completely shock value at tax time. Last year, it was brutal. We came into tax time and they said, Steve, I passed the adjusted gross income. I'm paying 85% of my benefit is being exposed to ordinary income tax.
Yes.
And so everybody, and you have a worksheet, so do I.
Yes.
If you say, Steve, how do I know I'm going to pay? If you say, Steve, I want to order the Social Security tax worksheet.
Oh, yeah, we'll send it right out.
We'll send it out to you, Steve, at lifesizesolutions.com. And you'll be able to walk it through. It's not too intense. It's pretty easy. You just got to know how to match it up.
Yeah.
And you're going to find out, Steve, there's got to be a better way. And there is.
Yes.
But let's just talk about it. So Social Security is going to be taxed.
It's possible, but the majority of Americans, it will be taxed.
Okay. Now, I was in shock because a lot of seniors, my predecessors especially, bought municipal bonds because they were promised either it's going to be federally tax-free, state tax-free, or maybe municipality tax-free.
Somewhere tax-free,
and maybe
right.
sometimes 2 of the 3.
Yeah.
But I didn't know. This is back in the day when I was a young buck.
Yeah.
I did not know that my tax-free bond income, even if it was tax-free, it flows over to the provisional income test for Social Security and causes my Social Security benefits to be taxed. How can that be?
The government wants your money. They want your money. They want tax money. They want to get it any way they can. And if they think that you're using too much of any one thing, let's say municipal bonds, they're going to earmark that. They're going to set that up so it'll be a preference item, and you're going to be taxed on it.
Okay, well, let's just slow down there for a second. If I have municipal holdings, and some of those holdings are qualified under the IRS definition of what a preference item is, you could not only is this all going to flow over to your Social Security,
exactly,
but you could trigger the alternative minimum tax. I mean, that could be a problem.
It's an additional tax on top of what you're going to be paying anyway.
How'd you like to tell some senior, hey, I'm sorry to tell you this, but part of this is alternative minimum tax and it's causing your Social Security
especially when they bought something thinking that it was going to be tax-free.
Yeah, the government is, there's a clandestine stealth tax trap here. So, I just want to inform you, listen, every product except for 4 is going to cause some ramification, not only on the tax side of this issue, but the Social Security benefit side of that issue. So we need to be aware of that.
Absolutely.
All right. Now, I just had a client who finally took some money off the table. It's been a great run. And at the beginning of the year, he took money off the table. And he was proud of his capital gain treatment. Who wants to pay ordinary income tax when I can pay less capital gain tax? But here's my question.
Yes, sir.
He thought he was in the 15% tax bracket. Of course, when you're making $250,000 adjusted gross income, no, you're not.
No,
okay.
No, you're not.
But he thought he's paying 15%.
Yeah.
Then I said, well, no, you might be paying 20%. And you said, no, you might be paying 23.8.
Yeah.
Well, I mean, the Obama surcharge on capital gain. Now, we're paying 23.8. We could be paying, depending upon our just 23.8. But all the gain. All of the gain. You're telling me that even though he paid 23.8, I thought the bleeding was over. That still goes over to the Social Security, right?
It does, and then you're taxed on the Social Security side too. Yeah, the benefit.
Ordinary income tax. Over here, I'm paying capital gains.
Sorry, yes, in your ordinary income benefit.
Unbelievable. So over on this side, I have Obamacare, and I'm being taxed capital gain and his surcharge. And over here, because it affects my Social Security benefit, I'm paying ordinary income tax.
Yes, you are.
You see, I'm sorry, but most seniors don't know that. And when they find it out, I can understand that they're a bit of angst and maybe even anger.
Very angry, actually.
Okay. Now we're going to introduce kind of the segment to come by talking about these 4 things real quickly. Now, so just to redux. So for Americans that are lower middle class and below, probably you're okay. I don't know for a fact. You're probably okay. And with the new tax code, with what has happened, the deductions for seniors have went up to $24,000.
Yes.
Mom and dad, if you're 65, you get an extra $2,600.
Yes.
And the taxable marginal brackets have come down.
Which is great.
Which is great. And I have people here in Arizona that are making $80,000 adjusted gross income that may not pay any federal nor state tax. Wow, that's great. That's great. That is. All right, but for people that are upper middle class and above, you're all getting hit some degree.
Absolutely.
Some degree. Okay, so when I go to my CPA, I empty out my shoebox of all my receipts, everything, and he does everything after the fact.
Yes.
When you're talking to your clients, you're already doing proactive for the next year tax planning. How big is this in retirement?
Proactive is huge. I mean, you think about it. You know, if you're reacting to things going on around you, all you can do is figure out after the fact what you're left with. But if you're proactive, you say, hey, I've got a choice. And choices are really what people want. And if nobody's telling them what those options and those choices are, then how can they put themselves into the right position? So when I give them the options, when I give them choices, they feel liberated. They feel like a weight's off their shoulder.
Well, many people, and if you think like I do, I try to be simplistic. I just make basic silos in my head.
Yeah.
I have taxable, tax deferred, and tax free. Everybody has some conglomerate of 1 or 2 or 3 of these. When I look at that, I did not realize back in the day how important it was to manage my taxes proactively. So I today do proactive tax management with, of course, your CPA or your accountant. And I do it in such a way where we're saving 10 to 15%. I know you do the same thing now.
That is huge.
10 to 15% a year on taxes. Now, who can't need the cash flow of another 10 to 15%?
Oh, absolutely.
Everybody needs it.
Yeah.
So this is why it's important. Now, I just want to, for just a redux,
yes,
we're going into the next one. There are only 4 things. We're not going to talk about it now. We're going to talk about it in the next segment.
Yes.
4 things. One of them is what? Tax-free, and it doesn't include in your Social Security.
A non-modified endowment contract.
So cash value life insurance.
Cash value life insurance. The other one would be a Roth IRA.
Roth IRA.
Which you're also going to be looking at is...
You told me, I think you said something about a reverse mortgage. That income doesn't do it?
It's a HECM, yeah.
It's a HECM?
Yeah, exactly.
Home equity conversion mortgage for you acronym people. And the one that I'm into is HSA account, which I'll tell you when we go to the next segment, I'll tell you why it's so hot. Those 4, shockingly so, don't memorize what is or isn't taxable with Social Security. Just say these 4. HSA accounts, reverse mortgage, cash value life insurance,
and
Roth IRA. Roth IRA.
Yes.
They're not includable. Everything else, that means every qualified plan under ERISA is going to be taxed.
Everything's going to be taxed except those 4.
All right. Now, in fact, I think it's easier to memorize the 4 that aren't than everybody else, because everybody else is under it, including municipal bond income, which we talked about, and capital gain treatment.
Yeah.
I mean, so now that we have an idea, this can add, when I take Social Security taxation and all the taxation of my qualified plans, all my taxation on municipal bonds, which I thought was kind of free, but I guess not, capital gain treatment, which I thought was less, I wasn't paying as much tax, but it sounds like they're catching me at Social Security, so I'm getting double hit, capital gain treatment, and Obamacare if you're a big ticket AGI. All these could add up to 40% of your portfolio.
Absolutely, and then when people find that out, they're just, well, let's just say they're shocked.
Well, not only shocked, but think about this. People like Lindahl actually go out of their way to do some proactive planning with your CPA or your accountant so that you do not undergo the loss of cash flow during retirement. Listen, don't forget to watch our next segment on putting more money into your pocket with tax-free retirement alternatives, part 4 in our series on your retirement reality check. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or in this case, your financial advisor. You're watching Steve Savant's Money the name of the game.